$35 billion. That's how much Warren Buffett put into Apple, making it the single largest equity position Berkshire Hathaway has ever held in its 58-year history. Not a starter position. Not a test a conviction bet so large it would make most hedge fund managers physically uncomfortable. But here's what nobody is talking about. Buffett didn't buy Apple because it makes great phones. There's something buried inside this position that the financial media completely glossed over. Most analysts looked at the headline number and moved on. But when you dig into why Buffett deployed $35 billion into a single ticker, the reasoning reveals a playbook that could change how you look at every stock in your portfolio. By the end of this video, you'll see exactly what Warren Buffett saw in Apple that the rest of Wall Street missed, and what it could mean for your money. Let's establish the scale of this first, because the raw number alone doesn't do it justice. $35 billion. At various peak weightings, Apple has represented over 40% of Berkshire's entire public equity portfolio. Think about that for a second. The man who built his entire reputation on diversification, who told generations of investors never to put too many eggs in one basket, went and put nearly half his basket into one company. Why would Buffett do that? Why would the Oracle of Omaha, a man who passed on Amazon, passed on Google, passed on Microsoft for decades, suddenly go all in on a tech company? The answer is, he doesn't think of Apple as a tech company. And that distinction is worth everything. In his own words, Buffett has called Apple, probably the best business I know in the world. Not best tech business. Best business. Period. Full stop. Here's what he actually sees when he looks at Apple. He sees a consumer products company with switching costs so deeply embedded in human behavior that they function like an economic moat, not a software moat, not a patent moat, a psychological moat, the kind that's almost impossible to model in a spreadsheet but nearly impossible to compete against in the real world. Think about the last time someone you know switched from iPhone to Android. Really think about it. The friction isn't technical, it's emotional. The iMessage bubble, the AirPods switching seamlessly, the Apple Watch on the wrist, the iPad on the coffee table. Apple doesn't sell devices. It sells membership into an ecosystem. And that ecosystem, that's the real asset Buffett bought $35 billion worth of. Now let's talk about the financial architecture underneath that ecosystem. Because this is where it gets genuinely interesting. Apple's services segment, App Store, Apple Music, iCloud, Apple Pay, Apple TV Plus, has been growing at a rate that the hardware business simply cannot match. Services carry gross margins north of 70%. That's compared to roughly 35% for the physical hardware. So every dollar that shifts from selling iPhones to selling subscriptions is a dollar that becomes dramatically more profitable. What Buffett recognized, before most institutional analysts started updating their models, is that Apple was quietly transforming itself from a hardware manufacturer into a recurring revenue machine. It's the difference between a car dealership and a toll road. One transaction is a one-time event. The other collects every single day, rain or shine, whether the economy is booming or in a recession. And here's the number that crystallizes that shift. Apple's installed base has surpassed 2 billion active devices globally. 2 billion. That's a platform. That's leverage. Every one of those devices is a potential services customer paying Apple month after month after month. But let's be honest. No analysis worth watching only tells you the bull case. Because there is a bear case here. And it's one that deserves serious attention. China. Apple generates somewhere in the range of 17 to 19% of its total revenue from Greater China. And the geopolitical risk sitting underneath that number is not trivial. The Chinese government has already restricted the use of iPhones for government employees and Workers at state-affiliated institutions. That's not a rumor. That's a documented policy shift. If that restriction broadens, or if trade tensions escalate to the point where Apple faces retaliatory action in its second largest market, the earnings impact would be immediate and significant. There's also the question of hardware stagnation. The iPhone upgrade cycle has been lengthening for years. Consumers are holding onto their phones longer, without a category-defining new product, something that moves the needle the way the original iPhone or Apple Watch did. The hardware growth story starts to look more like a slow grind than a rocket ship. But here's what could make this entire thesis wrong. And almost nobody is framing it this way. The real hidden risk in Apple isn't China. It's not the upgrade cycle. It's regulatory pressure on the App Store itself. The App Store generated an estimated $85 billion in gross billings in a single recent year. Apple takes a 15 to 30% commission on digital transactions processed through that platform. That commission structure is currently under assault from regulators in the European Union, the United States, South Korea, Japan, essentially every major developed market where Apple operates. If regulators succeed in forcing meaningful reductions to those commission rates, the services margin story, the exact story that justifies Apple's premium valuation multiple, starts to unravel at the seams. This isn't theoretical. The EU's Digital Markets Act has already forced Apple to allow third-party app stores in Europe. The legal battles in the US are ongoing. The irony is brutal. The very asset that makes Apple so attractive to long-term investors, the sticky, high-margin services ecosystem, is the same asset that regulators around the world are now treating as a monopolistic chokehold. Buffett bet on the moat. The regulators are trying to drain it. So where does that leave you? Here's the verdict, and it's one that cuts both ways. Warren Buffett's $35 billion bet on Apple wasn't a tech bet. It was a bet on consumer behavior being nearly impossible to change at scale. It was a bet on a business model that prints recurring cash flow through recessions, rate cycles, and geopolitical headwinds. It was a bet that 2 billion people, once inside Apple's ecosystem, simply don't leave. That thesis is still largely intact. The services margin story is still compounding. The installed base is still growing. The brand still commands a price premium that virtually no other consumer hardware company on earth can replicate. But the regulatory risk is real. It's accelerating. And it is not yet fully priced into the stock. That's the asymmetry worth watching. If Apple navigates the App Store regulatory pressure and maintains its services margins, the long-term earnings power of this business is extraordinary. If it doesn't, if regulators structurally reduce those take rates, then the valuation math changes significantly. And here's the question that nobody has cleanly answered yet. If Apple's App Store margins get structurally compressed by global regulation, will Buffett hold, add, or walk away? His track record suggests he'll hold. His comments about only buying businesses he'd be comfortable owning forever suggest he already stress-tested this scenario in his own mind before he ever deployed a dollar. But the rest of Berkshire's shareholders, and every retail investor who followed this position, are about to find out whether that conviction holds under real regulatory pressure. That answer will tell you more about the durability of Buffett's investment framework than any annual letter he's ever written. Buffett's $35 billion Apple position is the single most concentrated bet of his career. And it either validates everything he's ever said about consumer moats and recurring cash flows, or it becomes the one exception that proves the rule. I'm saying it holds. Agree or disagree? Drop it in the comments. This video is for educational purposes only, not financial advice. Always consult a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results.